G'day guys, Jason here from Positive again, and welcome back to the Friday update, bit of a market release, some tips and strategies. Hey, today I'm going to talk about a couple of things about buying property and how we buy property. When we go ahead as investors and buy a piece of real estate, how do we own it? Do we own it in our personal name? Do we own it in a company or a trust structure? Potentially even own it in a super fund? And how the right choices at the beginning as a property investor in the early days will make a massive, significant financial difference at the end, or maybe our goal or our financial goal we're going for, how those things can be impacted. Let me go to the board. I always like to sort of write things on the board and show an example of what I mean when I'm talking about how we buy properties, how we structure them, how we own them. For every investor, everyone that I've known, I've mentored and coached a lot of people around Australia in property investing, and in all investors' portfolios and processes and lives that they move through the investing, their investing career, there's three stages or three processes people go through. The three stages I've seen again and again and again are the acquisition phase, where people, investors, are coming to buy property. They are wanting to grow their wealth. They're wanting to grow the base value of their property portfolio as big and as quick and as safely as possible. Quite often in the beginning, you want to try and get your loan to value ratios at 80% or 90% as high as possible, because if you borrow at 80% you can buy one property. Potentially if you borrow at 90% with the same money you could buy two properties. Okay, you're not putting in any more money, but you're borrowing at a different loan to value ratio. You should talk to a great broker who can help you understand what that means. Good leverage, safe leverage is very, very powerful at property investor, but I'm not talking about that today. I'm talking about the acquisition process, high loan to value ratios. Quite often, for many investors, we have a negative cash flow associated to our portfolio in the beginning, which holds us back. Okay, and so as a property investor, we need to take advantage of tax deductions, which are very important. Tax deductions are a bonus of buying real estate. They're not an investment principle, but they are available. We must use them. If you saw my video a little while ago, it showed you how to take property depreciation and property losses, not cash losses, but losses because the ATO allows us to depreciate a property that we own, and use those losses to minimise our tax and get our tax back weekly and fortnightly and monthly. Don't wait till the end of the year. So in our acquisition phase, we must make sure that we keep our cash flow high, we leverage and make the most of our money, we don't have any lazy equity laying around, and we buy as much property as safely possible for our situation or our goals and aspirations. So in acquisition phase, that's fantastic. At some point in the future, many investors that I've worked with say, all right, that's enough. I've got 8, I've got 10, I've got 20 properties. Now I want to get into what we call consolidation phase. Okay? And consolidation phase quite often, not sold, quite often requires selling some property and reducing or paying out our loans and reducing our loan to value ratios. If we've got an 80% loan on our $5 million portfolio and we pay half of that loan off, then we've only got a 50% loan. Our loan goes down and our cash flow goes up. And so we help our investors in their strategies at Positive Real Estate buy property and get ready for that consolidation phase to pay property or pay debt down. Get rid of your owner-occupier debt 100%. It's a bad debt and we shouldn't have it. But use that equity or use that property to buy more properties as we go forward as a property investor. Because that's what we're doing. That's what we're here for. We're buying assets to build for our future. And so the last phase where people get to is a lifestyle phase, right? Lifestyle phase or a legacy phase. Some people some people want to leave something behind. They want to do something special for their kids or a special charity or whatever it is. But today I'm talking about these three phases. When we are in acquisition phase, we need to be clever how we buy these properties. There's three ways we can buy property that are sensible as a property investor. All right, you can buy those properties in your personal name as Joe Bloggs or Mary Smith or whatever it might be. And the reason we buy in our personal name is because most of the time it's very, very easy to borrow money. Very easy, simple and straightforward. And we get tax deductions on those properties very, very simply and very easily. It's really the simplest, straightforwardest way to buy and own real estate and manage it. We have some risks associated to that, and that's something you should always consult an accountant or a financial planner about. But in your personal name, the benefits are easy to borrow money and you get tax deductions. Last time I did my video, if you get personal tax deductions, you can potentially pay zero tax legally if you use your tax deductions correctly and get that right, which is fantastic. I'd be happy with that, and most people as property investors need to use that as a bonus in the beginning. You can own property in a company trust structure. Okay, company and trust structure. Now, the benefits or bonuses of a company trust structure is you have some protection, some asset protection. You're able to do some things in the future in that planning point of view. However, at the moment, and especially right now in this lending marketplace, it's very difficult to borrow on those structures, and it's having some adverse effect on our investors. You cannot, unless you use specialised trusts, but usually you cannot use the negative gearing or the tax deductions in your company and trust structures. Super funds. A lot of people are buying property in their super funds and using a self-managed super fund. Now, the upside of a super fund is that did you know that if you buy property in a super fund and you sell a property after the age of 60, you pay 0% capital gains tax. And that's a great benefit, but for some of us, if we're only 30 or 40, we don't want to wait that long, okay? But some of us are in our maybe 45s and 50s, and it's a great thing to be putting property in our super fund if it suits your specific situation. You should speak to your financial planner or your accountant about that. So as we buy properties, we must make conscious decisions and plan how we structure our investments. And some of the things that we help our investors do, some scenarios, we say, why not buy 5 properties in your personal name, Mr. Smith, and you will be able to reduce your tax potentially down to 0. And because you're aged 50, let's say, why don't we buy 5 properties in your super fund, and you can sell them after you're 60 and pay 0% capital gains tax when you sell them as well, and you can pay off the other 5 up here. So anyway, guys, there's some things to think about as a property investor when we buy property and how we structure things. This is a little bit more complex than a 5 or 10 minute conversation today, so I encourage you to get along to see our coaches and our professionals at our property information nights. They'll be able to speak to you about these things. They'll be able to point you in the direction of the professionals that help us, our accountants, our financial planners who know what they're doing, can achieve this for you and your specific financial circumstance. So anyway, hopefully that was useful today, guys. Take care at the marketplace, and encourage you to get along to one of our property information nights soon. Bye for now.